Okay. Excellent. I'm seeing more of the people I anticipated signing in here. So do want to be respectful of everyone's time. I know this does start at 12, so I won't delay any further. But once again, for those of you who've signed in, thank you very much for joining us today's financial wellness webinar. This is part of a series we've been doing for several years now. And for those of you who are interested, this will be recorded. The slides I show later will also be available, all of this on our website. We just redid our website, so you're welcome to go and take a look at it. Under our Client Center, you will see this recording as well as many of the other topics we've covered. Some of our most popular have been on estate planning. We brought in a local estate planning attorney, or actually a partner at a local firm. We also have one on end of life planning. We brought in a third generation owner of a funeral home. And a perennial favorite has been one where we brought in the director of technology at a major law firm to go over cybersecurity and identity protection. So this and all of those are available again on our website under our Client Center. Today's topic, I think I'm very excited to go over today. We're going to be talking about annuities. And this is something I think that there's a lot of misconceptions around annuities, a lot of misunderstandings. And the best way to put it, my dad has always said, is there's a stinky aroma around annuities. And so a lot of people will write them off because they're in the back of their mind, they've been told things that they shouldn't use annuities, even if they're not sure why. But there's also times that people just to accept an annuity from someone that probably was not appropriate for them. So the goal today, there are thousands of variations of different types of annuities by different companies. So I'm not going to go deep into the weeds, but I do want to create a better understanding of when are annuities appropriate and how can they be used as part of someone's financial plan. They're not appropriate for everyone, just like any other type of insurance or investment product, but there are certainly people that they are useful for. So I want to make sure that we go through that. And then, please feel free to ask questions as we go through. There is a chat feature and a Q&A feature in here as well. You can reach out with either of those. I'll either answer it while I go, or if it's something to talk about at the end, I'm happy to do that. Annuities are also something that are very individualized. As I said, there's over 1,000 different options depending on the type of annuity and then specific products with specific companies. So I'm happy to have a conversation myself or one of the other advisors here to go through what, if anything, is appropriate for you. One of the other things that I like to bring this up for are there's some companies where you look and everyone has an annuity. And it's the question of, well, was that appropriate for everyone? Was that in their best interest? Or is this a situation where a hammer sees a nail for every problem? But I've also seen on the other end, and not to pick on anyone in particular, but I just got an advertisement yesterday from Fisher Investments, and the big ad is just the word annuity in a red circle with a line through it, and it's just off the board. Nobody should have an annuity. And it's the same thing. Is this something where that's what's appropriate for everyone, or is it something where, they don't have a hammer, so they don't see the nail? So we just want to make sure people are comfortable with how annuities do work in a financial plan, and then we can have further conversations if they're appropriate for you. So with that, I will share my screen here. Go into my annuity presentation. Wonderful. Okay. So, as I said, today we're going to go through kind of the basics here. So, just what are annuities? What are their benefits compared to other investment products? What are some of the misconceptions out there? More specifically, we know what an annuity is, but then what are the different types, right? There's several different types that also fill specific roles. How can they provide guaranteed income and really guaranteed returns for some of these? What are some of the riders that are added on generally to different annuities? When are they not appropriate? As I said, not everyone should have an annuity, right? There's people that don't need them that unfortunately I see are sold them from time to time. So just really want to make sure people understand when is it appropriate, how to evaluate the specific product you have. So Sometimes if someone works just with one company, then they only sell that one company's products. And maybe that you should have a variable annuity, but not that specific one, right? There might be some other concerns based on health, based on age between spouses. So we'd go through what are the things you need to look at when evaluating what annuity product is right for you, if any. And then at the end, there's just a couple conclusions and happy to answer questions as we go. As I said, there should be a chat feature and a Q&A option. So, said, what are annuities? Really, annuities are essentially a type of insurance and oftentimes used to provide either a stream of income or a guaranteed income or guaranteed rate of return, and typically meant for retirement planning. Now, and I'll go into this with things like fixed annuities and such, there are instances where it's not retirement, it's a very specific goal you may have that annuities can fill. But essentially, it is an insurance product that is meant to give you some guarantees. How it works, oftentimes you invest either a lump sum or else you make a series of payments, just like you would make to a contribution to an investment account. And that grows on a tax deferred basis. That's one of the big benefits of annuities. If you put it in a, if you were to put money in a regular non-qualified account, every year you get a 1099 from the company saying, hey, you made money, you got dividends, you got interest, you sold something. If it's in an annuity, there is no 1099 until you choose to start taking money out of it or until it matures. So that's one benefit as well. So also that's the tax deferral in the key benefits section. Many offer predictable income, right? That you can annuitize the product, or they have an income rider. And so you know exactly what you are going to get depending on what date you turn on your income. If you may be 60 years old and you're looking to build your own pension, you could use an annuity and you know exactly if I put in X dollar amounts every year for the next 5 years, what my payout will be. So it's a way to get predictable income not tied to the markets, to do it in a tax deferred basis. So I'm going to move to the next page here. There's different benefits of annuities. So, as I said, sold by insurance companies. Unlike life insurance, which is to protect you from passing away before you anticipate, annuities are a great option for someone with longevity in their family, and they're looking to make sure their money can't outlive them. So many of these different products have guaranteed income, whether it be fixed annuities, immediate annuities, or variable with a rider on them, and I'll talk about that later. But with the loss of pensions being offered by most companies, annuities are one way that people are able to get guaranteed, predictable income in retirement. Oftentimes, we'll stack that on top of Social Security. And as I said, I'll go into that more as well, but it's something where with clients, we'll put into financial planning software and say, this is how much money you need in the future. What if we can know Social Security is going to come in, your annuity is going to come in, and maybe require minimum distribution. And now you don't have to worry what happens in the market because you have these sources that are going to come in really no matter what. The other option thing here as well is tax deferred growth. So depending on oftentimes someone approaching retirement is in their highest income years. Maybe they've maxed out a 401k, their employer doesn't offer 401k, and so they're looking to keep their tax return low. I've also used this with clients who they've retired early and they're living on the Affordable Care Act health plans. And so those are driven by your income. So they may have a large amount of cash that the 1099s, the dividends and interest that they're not using keep showing up on a 1099 and keep disqualifying them for the reduced premiums and reduced deductibles. So they put money into a annuity, whether it be for a fixed period of time or for the rest of retirement, and all of a sudden those 1099s disappear, their income shows much lower, and they qualify for things like Affordable Care Act benefits. Also, protection against market volatility. So there's some products, a fixed annuity, simplest out there. You have a guaranteed rate of return for a guaranteed period of time. Similar to a CD, similar to a treasury. Be very clear, they're not FDIC insured. They are not backed by the full faith and credit of the US government. They're backed by the annuity companies you look at, but a fixed annuity conceptually works that way. I buy a 5-year fixed annuity, 5% interest, and every year compounding, I get my 5% interest until year five. And then the CD matures. I'm sorry. Oh boy. The fixed annuity matures, and you can either choose to keep it at whatever rates are offered at that time, roll into a new one, or take that money and run. So that's one option that I've seen clients use where maybe they sell a house, they plan on renting for a few years and then buying a new one, but they need the money available in 2 or 3 years. The concern is if you put that in the market, it's going to go up and down with the market. And so, God forbid you call and say, okay, I sold my house. We sent 200,000, it got invested, I need it back, and it's worth 190 because the market went down. A fixed annuity would be a great option for that. Great, we get 5% for the next 2 years, we get our money back, and then we're ready to buy that new house. So that's one thing I've seen it used for. There's also index annuities. Sometimes clients will come to us, and the concern is, I'm worried about the markets, but I know I need to have some exposure. Right? I know I need to earn more than inflation, but I get a heart attack every time my May statement is worth less than my April was. Index annuities have the option where you can index it to an annuity rate of return, but oftentimes there's caveats. Either you can't earn the full rate, there's a cap. Maybe the S&P goes up 10, you only get 5.5. The other option would be, apologize if that call came through. You would get something in 5.5 instead of the 10. There's some where there's a spread, so you get 2% less. There's different options, but the more important part is on the downside, you can lose nothing, right? So if the market goes down 10, you get a zero rate of return, which obviously, if you're someone that gets nervous about your statements being down 1 month after the other, is a great option. Oftentimes, too, you can tie these index annuities with riders that while it's accumulating, you're not going to lose money. You have a cap on how much you can make, but you're not going to lose money. And then once you've retired, you can turn on an income stream that's also guaranteed. So these can be for very conservative investors, kind of checks all their boxes as an option. There's some other things out there as well that have come up where instead of having no downside, you can opt to say, I want a company to eat the first 10 or 20%, and then anything more than that, I'll take. So you could take a 10% buffer, they call it. Market goes down 15, you're down 5 because the company took the other 10. So there's things like that that are available for people who are more conservative investors. Go to my next page here, and I don't my Zoom isn't showing me if I'm going any questions, so bear with me one moment. I'm just going to make sure that I don't have anything coming in from that, and it does not look like I do. So okay, I'll keep going here. So some of the misconceptions, as I said, the phrase my dad had always used was that annuities have a stinky aroma around them. So I just want to cover some of the reasons people think that. Uh, First one is annuities are only for the elderly. As I said, that's not always the case. I have some people who retired early. And so, depending on what you consider elderly, most people wouldn't, someone that retires in their 50s. Right? That might be someone who we're trying to use the tax deferral benefit. Oftentimes, it's something where someone is trying to prepare for retirement and they want a guaranteed income stream, and they have the income now while they're working to fund it. So it's something, again, someone in their 50s or 60s are funding one of these. Or it's a shorter term. As I said, people where they know they won't need the money for 2 or 3 years, but they don't want any risk to it. They're just looking at something better than they could in a savings account or in a CD, so they use a fixed product. Um, You'd be any age for something like that to be appropriate. So it's not just for the elderly. It's someone who typically just has longevity in the family and wants to have guarantees throughout their lifetime. But there are even shorter term options for younger people, as I said, like a fixed annuity. Funds are locked forever. So oftentimes people are afraid if I do an annuity, it's a one-time decision and stuck with it. It's actually a little bit of it works in your favor. So most annuities, you are not locked in forever. As I said, a fixed annuity is the easiest one to understand. If you pick a 5-year fixed annuity, the funds are locked in there for 5 years. If you take it sooner, there's often things called the surrender schedule where you wouldn't get to keep it. You might lose 3%. You put in 100,000, you might get 97 back if you try to take it within the 5-year period. Um, However, most annuities offer a 10% of your contribution, your premium can come out every year, penalty free. So if you put a large amount into an annuity and you need money back quickly, typically, and this is something important to check, you can take 10% out every year, just regardless of the surrender schedule and other penalties. So that's one benefit to them. Oftentimes, too, that other annuities, whether it be variable or indexed, also have what they call surrender schedule. And that depends on the company, depends on the product and some other factors. But you might be looking anywhere from 5 to 10 years. If you were to take your money and run from with an annuity, you might not get to, as I said, not get to keep everything. There's a certain percentage that doesn't come back to you because there was a cost to the insurance company up front to give you the product, and there's certain long-term investments they made, certain payments they've made that they keep part of the money if you take it in that surrender period. Some of the surrender periods, depending on the product, can be waived, whether it be for long-term care, a chronic illness. There's certain things that will waive the surrender period. As I said too, you can take out money within roughly 10% each year, despite a surrender period. And then, oftentimes when we're looking at these products, though, we're making sure that the only person that's using this is someone that wouldn't want to surrender the product within the next, 10 years and at the more extreme end. So if you have someone that's buying one of these, you have to make sure there's other assets because there is a certain lockup period. Make sure, there's other benefits to this. So is there enough of a benefit that there would be no reason for you to ever break this and try to get out early? But the other side of it too, what I've seen is some of these products were priced too favorably for the consumer. And so companies then made changes. But if you've signed a contract with your guarantees, it is locked forever. They can't go back and say, oh, we're changing how much we're charging you. We're changing whatever your interest rates are outside of what we already guaranteed you to begin with. So this is something where it can benefit you. Once you've bought it, it's yours, and it can only change if you want it to change. You do also have the option to do what they call a 1035 exchange. You can transfer from one annuity to another, very similar to a rollover of retirement accounts. So there's no tax penalty for moving from one IRA to another. And so sometimes you'll see that someone will buy annuity 15 years ago. Their situation has changed, hopefully for the better. And so the product they bought 15 years ago may not still be what they need. If they leave the annuity space and it's not within an IRA, then there's a tax bill due. So we can just 1035 it, they call it, into a different annuity that now fits their new needs. Um, Same thing here. All annuities have high fees. So there are some annuities with higher fees. Oftentimes it's because there's a guarantee tied to it. Right. So if there's annuities typically that have guaranteed income for life, it's a rider on an annuity or a death benefit that's higher than what you put in. Well, where does that money come from? It comes from the fee that you pay and everyone else that pays that. It goes into a big pot. That big pot effectively is invested in longer term assets. And then if you ever run out of money, but it's still guaranteed for life, that pot is what feeds that. There's a death benefit. That pot is what feeds that. So there are fees in most annuities that pay for the benefits that you have. But there's also some that effectively have no fees. So, certain index products, certain fixed products, and certain variable will have things built into them that there's no additional fees for you. So for instance, the index annuities I talked about earlier. Yes, there's no downside protection. There's 100% downside protection, but there's a cap on the upside. But there's some benefit to the company when the market goes above what they have to pay you. So there's certain things that are fixed into into how these different annuities work. Same thing with fixed. Maybe they pay you want to buy annuity 5 years, 5%. You don't have to pay a fee every year for that benefit. Just maybe the company's getting 5.5%. So they're keeping that other 0.5%, but it's not costing you anything to have that fixed annuity. And there's different annuity products out there that allow you to have a low fee or no fee. And oftentimes, if you are paying a fee, it's because there is a benefit you're paying for. Again, oftentimes with the clients I see, it's a guaranteed death benefit or a guaranteed income for life. And the way they guarantee that is because they have a rider that's paying for it. And also, myth that annuities have a low rate of return. So it depends on what product you're using. And so sometimes for clients, again, all we're trying to beat is what they could get in a CD. And so we're getting a fixed annuity that pays a little bit more. Maybe it's an index annuity. Oftentimes, those are meant to really replace or augment your bond portfolio. So, yes, it's a lower rate of return depending on what you're looking at, but studies have looked at and found, okay, well, fixed annuities typically pay more than a CD or a treasury. That fixed indexed annuities typically do better than a pure bond portfolio. Um, on the other side, too, with some of these annuities with guarantees, for instance, many clients we've worked with who have guaranteed income for life and a death benefit. Well, now they've really shifted all the risk to the annuity company because even if the market goes to zero, you're paid your guaranteed income for life, and there may be a death benefit. So if the annuity company's taking the risk, that investment will be one of their most aggressive investments. And oftentimes that ends up with a higher rate of return than some of their other products, even with the higher fees, because again, they have the guaranteed income and death benefit, but they took more risk than they would have. And if you're buying this for guaranteed for life and you're 60, well, you might have it for 25 years. And having 10 or 15 or even 20% more in the stock market over 20 to 25 years makes a huge difference in your long-term rate of return that you may not have been comfortable without those guarantees. So again, some do have a low rate of return by design. You're just looking for a fixed number that beats a bank product. And some can have a much higher rate of return than your other options because you're more willing to take a risk and be in the market. I'm going to pause there for a moment too, just to see if any questions came in here. I don't see any. Keep going from here. So now I've been referencing different types of annuities. As I said, here there's four main ones that I'll be discussing and I have been discussing. Then there are multiple companies that offer different versions of these types of annuities, which is why I was saying earlier, there's really over 1,000 different options available to you. The fixed annuities are the simple one I talked about earlier, where oftentimes either it's set period, set interest rate. There's others where there's no set period. It's just you get a fixed interest rate as long as you own this thing. There's just a minimum, a surrender schedule. There's a minimum amount of time for you to hold it, but you could keep it for a very long time. I know people purchased some of these pre 2008 when the assumption was interest rates would never fall below 4% for any long period of time. So people had fixed products that paid them 4%. Interest rates fell after 2008 to stimulate the economy. And you went from 2008 to really 2018, where rates were below 2%, but you had a guarantee at 4, right? So there were some of these where it's just a way to get a very safe rate of return for either a set period or as long as you have it. And then also you can annuitize them. You can start churning on income. And so now, okay, I got my guaranteed rate of return. I don't need to return anymore. I need income. I want to retire. And you can get, again, it's a fixed payment that comes out of these. There are variable annuities. So to distinguish these would be very specific. Variable annuities are an investment product. So as you can see on here, it allows investments in what they call sub-accounts, effectively little mutual funds designed by the companies or sub-advised. And they go up and down with the market. You can do one with no bells and whistles. It's just a pure tax deferral play. As I talked about earlier, clients who are trying to avoid 1099s in a certain period of time for whatever reason it is, if they're trying to qualify for a benefit or just trying to keep their taxable income low, and paid out big dividends and interest and capital gains from an investment account. You can throw it into a variable annuity. 1099s are gone. Um, Oftentimes, you will also pair these with riders, as I talked about earlier, guaranteed income or guaranteed death benefit. So you put money into one of these, goes up and down with the market, but you also have, once you've turned on the income, it comes in the door, and it's either minimum income or it can be tied with the markets. And oftentimes it's a minimum income, and then if the market goes up, you can get increases, but you can't get decreases with some of these riders. As I said earlier, you pay for those, right? You're paying a certain percentage that funds one of these things, but oftentimes, I've had clients uh, go into their 90s with one of these, and there's still funds in there, even though they've been taking money out and paying fees and their own income every year because they took more risk, because it was really the company taking the risk because they had the income guaranteed. So these are something where there's several different reasons people would use variable annuities. They tend to be the more popular ones that we see. But as I said, also there's a death benefit for some of them. So you may have a client where they don't qualify, they couldn't qualify for life insurance, past cancer diagnosis, it's in remission, but it's too soon. Other health issues, heart problems, weight problems. Variable annuities have death benefits and no underwriting. So sometimes we've used this as a light version of a death benefit. You have your indexed annuities. Talked about these briefly earlier. You can pick an index. We're referencing the S&P 500. It's one of the most popular ones, but I've seen everything under the sun out there. There's the standard large companies, small companies, US, international, but there's some other ESG options. There's some that for companies with primarily women on their board. I've seen ones with companies that are it's a blended index, so you can choose how much risk you want to take. Maybe you don't want the S&P, maybe you want the Nasdaq. So, oh, what? Sorry about that. So there's multiple options. The bigger benefit to these is the no downside. So just like a variable annuity, oftentimes the index also allow riders for guaranteed income or death benefit. And these would just be more appropriate than a variable if someone was very risk adverse. So they just could not take a negative statement, or they need to know exactly what their income is going to be later in retirement. You also have immediate or deferred annuities. These are ones where essentially you take a lump sum, or you can make multiple payments, but usually it's a lump sum. The company takes those funds and then they guarantee you income for a set period of time. The difference is immediate. You get your income within 12 months. Deferred, you're waiting at least 12 months or more. So sometimes these are funded. Again, someone's in a higher income year, they don't get a pension. So from 60 to 65, they put in big lump sums, knowing that once they turn 65, they can start getting guaranteed income. They are something where you can pick the time period. As I said, it could be 10 years, 20 years, your lifetime, a mix of the two, as long as you're alive, or 20 years, whichever is longer. So there's different options with them. Not something that we have used as frequently, but this is the truest one to mirror a pension. Right? They tend to pay the most because oftentimes when you make your premiums, whether it be the lump sum or the multiple payments, those premiums are gone, right? You gave them the company, they use it to invest to be able to pay you over the 10, 20 years or your lifetime. And these also pay the most. That's why it's the most pension-like. Because the the other options I've given you, the fixed, the variable, or the indexed, there's still money available. You could turn around and take it back. The immediate or deferred, there's a lot more limitations on how much you could turn around and take back, if any. So guaranteed income from annuities, again, something I've been touching on as we go. So you can either some of the annuities, the immediate deferred options, for instance, and some of the fixed, that's just what they are. They are just designed for an income stream. There's no additional riders or benefits. That's what they do. But there are also riders, they call them, to an insurance product, additional language for variable and indexed that can say, hey, as long as you are alive, or oftentimes you and a spouse are alive, this income keeps coming. Even if the account goes down, even if the account goes to zero, you live a good long life, the markets are terrible, you're 85 years old, it's worth zero, you still get paid as if it's worth the highest amount it was when you own the product. So these are something where it's a great option for people that want some guarantees. Um, the other part is, again, predictable payouts. So, as I said earlier, for a lot of these products, you know the minimum you are going to get, and it can be calculated for you. What's it at 65? What do I get paid at 67? What if I wait till 70? You can really structure these things, and you know exactly what you're going to get and for how long. So these are some things I've been going over in the income rider, the death benefit. So I'm going to skip over those briefly. But well, I'll touch on the death benefit. Most products are what's it worth, or there's a special benefit, whether it be what did you put in, if that's worth more, or what did you put in minus what did you take out. And if the market's been terrible, that number is higher than what it's worth. So there are some death benefit options, some nifty ones we've seen in the past. The most generous I ever saw is what they call a W, where if you put in money, let's say you put in 500,000 into a annuity with a death benefit rider, and you spent it down and you died, your spouse would get 500,000, and then they could spend it down, and then when they pass, the kids get 500,000. That is very generous. They've closed that product, but there are similar things like that. So if this first spouse couldn't qualify for life insurance, which would be the best way to go about it, then we would say, okay, well, here's another option where you know your spouse is going to get at least the 500,000 you put in back. And then you know your kids are going to get that 500,000 back. So that's where some of these death benefit riders can be helpful. Inflation project protected riders. So there are some options either and you will get paid out a flat amount every year for the rest of your life. But there's some that they start at a lower amount and it increases every year, whether by a fixed, 3% or 5% compounding, or some of them are actually tied to CPI. And so every year they announce what's Social Security paying out, and that's effectively what your increase in your benefit will be. So there are some, right, having gone through 2021 and 22 with much higher inflation, we're still facing that to an extent now. You would be able to buy one of these products, and rather than watch your benefit get eaten away by inflation, you would see your benefit grow with inflation. Typically, as I said earlier, it's not appropriate for someone to have all of their money in an annuity. You should have annuity assets and then more than what you have in the annuity elsewhere. So many times there is a pretty significant reduction in what you get paid out if you choose an inflation rider, because the company knows they have to pay you more and more and more and more every year out of their control for however long you live. So they start the benefit at much lower. So oftentimes we'll choose the fixed benefit, knowing it will be worth less 20 years from now because of inflation, but also knowing your other assets will be growing faster because you're not taking money out because you have this income from the other annuities. So we will couple everything together that way, saying we're going to get an inflation benefit from your outside assets, we're going to get your guaranteed income and reduced the withdrawal requirements from your outside assets from this fixed annuity or this income rider. Then long-term care riders. So this has also become popular. The long-term care insurance, which we've done a webinar on before on long-term care planning, that also has its own benefits and uses. But one of the big concerns that people have is, well, like all insurance, what if I don't use it? Right? Ideally, you buy fire insurance, you buy car insurance, and it's a waste of money. Same thing with long-term care insurance, is you hope you don't have to use it. But then there's been some options saying, okay, well, rather than have you put money into a traditional long-term care product, you could put money into a annuity with a long-term care rider, and that allows you to get a benefit from your money, whether you go into a nursing home or you need care at home or you don't. You healthy life, and then you don't end up needing care, then you get all the benefits of the annuity anyway. You don't lose the money. But if you do need it, which more and more Americans do, there are benefits to you for an extended medical stay or nursing care. So as I said, does annuity make sense? So just using here a uh, a case study. So in this particular case, this is a woman named Susan. She's 62, retired school principal, and so she has 950,000 in retirement savings. As a side note, there's a great book called The Millionaire Next Door, and they did a lot of studies on this time when a million was just extraordinary amount of money. Who had the million? What particular qualities were there about them? And there's five main occupancies that people that most millionaires fell into. One of them, most fascinating, being teachers. Right? Your other ones, lawyers, accountants, business owners. A lot of those high income earners. So yeah, we see where they got their money. Teachers, no one's ever accused them of being high income earners. Um, were also on this list because they were high savers. So in this particular case, we're going with this retired school principal, 950,000 in savings. She does have a pension, does have Social Security, but very risk averse, right? Maybe a good saver, but doesn't love to be in the markets. So looking for a guaranteed monthly income. So in this case, right, this does check a box for annuities. We can use an annuity with guaranteed income. She can't lose, whether it be an index annuity or whether it be a fixed or a immediate annuity option. It limits her risk in the markets, can avoid managing complex investments. So a variable annuity, there is a limited list of investments you have in there that can be used someone like our office to help you build and then monitor. Or if you're using things like an index annuity, there's five indexes you can choose from in particular products. Or if you're using an immediate annuity, there is no investments. And then there's some flexibility for unexpected expenses. In this case, it would be something where you would have money, you wouldn't use the whole 950. You would use a portion of what she has. And the way we calculate that for clients, look at the budget. What do you spend? Okay, how much will be covered by Social Security? How much will be covered by her pension? What's left? And something in there of what's left we would use to buy an annuity to cover that differential. So here's an example. In this case, variable annuity with a lifetime income rider. She does a one-time payment of 300,000. When she turns 65, she turns on her lifetime income, and in this case, it'd be 1,500 a month for the rest of her life. And so that would be supplementing her Social Security and her pension. Because it's in a variable annuity, as I said earlier, this can be invested, goes up and down with the market. Her goal is to have the 1,500 for life, so we could increase the level of risk that she may take in here versus her other products because she's never going to get rid of this product. It's going to have the 1,500 a month. That's what she's looking for. The goal being if you take a little more risk, if it goes up enough, you might get more than 1,500 a month. You just can't get less. You can get more. Or for her heirs. This now we're investing for someone, if she's 65, maybe she has kids that are 35 or 40, and those kids now we're really investing for them because mom gets her 1,500 for life, and it's the next generation that's trying to balloon that death benefit. When not to use an annuity. So as I said, sometimes unfortunately you see it where every person that works with someone has an annuity and it's just a hammer seeing a nail for everyone. But that's not the case for everyone. So need for high liquidity. If we have clients who anticipate needing a large distribution from accounts, as I said, at most you can usually take 10% out a year in the first couple of years. So if someone needs to do something for purchase a home, job change, and they don't know what their expenses are going to be, a big move, you wouldn't want to lock money up into an annuity for something like that. Also, short-term investment horizon. So this would be, as I said, typically you're looking at surrender period of anywhere between, 5 to 10 years. So if someone's going to need the money sooner, well, most annuities wouldn't make sense. And even a fixed annuity, which is more like the CD or the treasury, those typically start at 2 years or longer for their guaranteed period. So, oftentimes if I have someone that's looking to do a shorter period than 2 years, you are looking at CDs, money markets, treasuries, some other shorter term products. The annuities would be someone 2 years or more. Primarily growth focused. So if you're someone that says, I don't really care about my guaranteed income sources, I don't care about a death benefit, I just want to see how much I can grow my account, well, annuity would not make sense because the products that don't have any fees don't give you the full return of the indexes you've chosen. The ones that do allow you the full return have additional fees because you're paying for things that you, in this case, you wouldn't use. So for people who are uh, just looking for how much rate of return can I get in my investments, and I don't care about income, I don't care about loss reduction. I'll take my negative 20 years if I'm getting my positive 20 years in the market. Then this annuity is typically not appropriate for them. Also, already sufficient income. So every once in a while, you talk with a very fortunate person who they don't spend as much and they have a big pension. And, sometimes I've seen it. A husband and wife both worked for a company or the government. They qualified for a pension. They retired early. They worked somewhere else. They qualified for Social Security. And so their income sources will fully cover their expenses. Well, there's no reason to get an annuity with guaranteed income or death benefit because you don't need to, right? That protection is not necessary for you. And so some people, if there is a gap between what they're going to spend and what they have coming in, yes, that might make sense. But if there's no gap or your gap is minimal and can be easily filled by, 4% or less distribution from your investments, these are not, you may not be a good candidate for a annuity. How do you evaluate the annuities that are out there? So again, what type of annuity are you being offered? And how does this affect you? So if you are someone who you want guaranteed income, but you also don't care, you're looking to grow the assets. You're willing to be in the market. You don't care about losses in any given year, then you should be looking at variable product, right? You don't want an index or a fix because that caps your upside, if any, because it gives you downside protection. If that's not important to you, then you should be looking at the variable. Or on the other side, if you've said, hey, I don't want to take risk, I'm scared of the markets, you should be in a variable product. There are better options for you. Again, like the fixed or the indexed. Is the income guaranteed? So a big one I've seen with people who've come to us as new clients that already have annuities is there's a lot of companies out there that will pay a huge amount up front, right? Maybe they pay you as much as 7%, but all you hear and all you're told is it's a 7% payout. What you don't realize is it's 7% until it goes to zero. Okay, well, how long does it take for my money to run out? Well, if there's a guaranteed income paying you 7%, there's probably a rider. You might be paying 2% on there. Well, now there's 9% a year coming out of investment. It's hard to beat a 9% rate of return every year. And in certain years, if it drops low enough, the contract value, but they're still paying you the high guaranteed income, it might be equivalent of 10 or 11% coming out. And so it's likely your investment runs out in 10 years. And then it goes from a 7%, it's still guaranteed for life maybe, but goes from 7 to 3. And we haven't factored in, well, what happens when your income goes from 7% of your payout to 3% when you turn 80? So that's one thing I've seen happen to people. I do see if a question come in here um, saying, how have you seen annuities used in combination with trusts when, for example, some of the beneficiaries are not financially savvy or suffering from a disability? That's a great question as well. So part of an estate plan situation would be if you want to avoid probate, for instance, and if you want to guarantee income over a period of time, you can use a trust and then put language in the trust. And again, I'm not a estate planning attorney, so you'd want to work with someone on this that would compel the trustee to purchase an annuity for all of or one of the beneficiaries if there's a concern, and that beneficiary would be paid for life. So, instead of receiving your lump sum of $100,000, that 100,000 would go into an annuity, and this person, as long as they're alive, or for a fixed period of, maybe it's 10 years or 20 years, they might get, their $500 a month. And so it's a great way to be able to protect someone who, again, is spendthrift provision, they call it, someone that's not great with money, or someone that has a disability. And so you don't want them to have a lot of money that they may not be able to manage, but you do want them to have an income Maybe it's to help with rent or with different medical payments. Now, there are some caveats, and again, this would be something to talk about individually. A annuity held in an IRA you have to distribute that income within 10 years. If someone passes away today, you have to follow not the annuity rules, but the IRA rules. That precedes and takes precedent over the annuity. So the IRA rules is if a non-spouse inherits, with some limited caveats, but generally, if a non-spouse inherits an IRA, they have 10 years to empty that annuity. So that would limit, right, your ability to do a lifetime distribution. You would only be able to do the 10-year option. There's also, depending on the trust is written, it could restrict it to 5 years. If you have a non-IRA, if you fund it from not an IRA, it can still go into your trust, and then that option you can stretch out. You can stretch out over 20 years or more. So that's something else that can be looked at. But there are certain restrictions you'd want to be aware of, but it is certainly an option. It's one, again, it can protect someone from themselves. It can allow you to help them over a set period of time, and also for tax reasons. So I've seen this used as well, where now one other thing is an estate planning option I've seen people do. Some charities now offer annuities. So you can go to a charity, you give them a donation by buying the annuity. So again, it might be $100,000 you take from your IRA, it goes to the charity, or you can take it from, a stock portfolio you have, and they use the 100,000 to buy an annuity on your life or someone else's. So I've seen this done where there's a sibling of yours who has not done as well financially. So you want to help take care of them. They're younger, they need assistance. You could either in your will or your trust have the charity buy an annuity. You donate them 100,000 and they buy the annuity on this person's life. You can do it today if you wanted while you're alive. But then ultimately the charity gets to keep some of those funds. So it's something that kind of satisfies both. I want to take care of certain people, and I want to make sure that there's a charity gets some of my money when I pass or even now. So they just call those charitable remainder annuities. You can buy them through the charities themselves. It's something we can assist you with, but that can open a whole nother conversation. So it is important to have. But thank you for the question. I think it is something to be aware of. How liquid is the contract? As I said, some of these contracts, might have a shorter surrender period. If you're doing a fixed annuity for 2 years, then it's liquid within 2 years. And you could take 10% out a year before that. Some of them don't offer the 2 year. Maybe the most extreme one I've seen, we've never sold this, but we did have someone come to us and we looked in and said, don't love this product. Let's see about other options, only to find out it was a 15-year surrender schedule. Could not get out of this annuity for 15 years after they bought into it. And the gentleman that sold them to it had them buy in every year another 50,000, meaning each 50,000 had a new 15-year surrender. And that's where annuities get these bad aromas, if you will. So the question just becomes, when will you need the money? And are there options if something unforeseen happens, long-term care, chronic illness, something else that you could take from the annuity sooner rather than later? Who is the insurer? So we only partner with companies that have the highest ratings from places like AM Best, the S&P, Moody's, because, as I said very early on, a fixed annuity, for instance, pays more typically than a CD or a treasury. Well, one of the reasons is it's not FDIC insured. It's not backed by the full faith and credit of the US government. You have to be comfortable that that annuity company will be there. If you buy a 10-year payout, hey, you guys going to be there for 10 years. If you buy that death benefit one I talked about, that's going to pay you, or it's going to pay your spouse and then your kids, what are they going to be around to pay those? So sometimes, right, you may have a company that's got lower fees than everyone else, or has a higher payout than everyone else, and a bad health rating. And that's the thing, is maybe that's not an affordable strategy. So we do only look at who has the best ratings. And then what are the fees? Are you aware of the fees you're paying? So as I said, some of these you are paying a rider fee. And hey, if you have to pay someone 1, 2% to get exactly what you want, it's probably worth paying 1 or 2% to get exactly what you want. But you got to make sure it is what you want, make sure the fee is reasonable. They do vary by products and by companies. And then also, there's other fees that you may not realize, right? In variable annuities, just like every investment out there, you pay the manager a small fee. Are you using the most cost-effective investment options inside your variable annuity? There's so just things like that to be aware of. And as I said, some of these products, like a fixed index annuity, if you don't have an income stream, there's really no fees you're paying. And there's newer products, registered index linked annuities, they call them, no fees that you're paying. So there are things out there. Uh, Again, just want to make sure they're appropriate. But I do always say, you don't want to say no to something because the fee seems off, but you're just unwilling to pay for exactly what you need. So some key takeaways um, on here. Annuities offer guaranteed income. They're really meant for longevity. They have guaranteed rate of returns. Some of them can limit your downside or eliminate downside protection. They're meant to complement pensions, Social Security, if you have a dividend portfolio. Uh, but you have to make sure they're appropriate for you. Right? We deal with annuities. We have clients come to us, new clients come to us already with annuities. We want to make sure we learn them, but these things are complex. It's very important that people fully understand what they have. So whether we drive people nuts or not, if we've sold new annuities, we spend a long time walking through all the different parts with them. And even later, it's been something that my dad had started as a requisite for all of our advisors is if you're meeting with a client at least once a year, you have to go through part of that annuity again. Really make sure people understand what are the moving parts in this product. It's good for you. And candidly, it's good for us because, as I said, companies will offer newer versions of these different products, and sometimes they eliminate things from old ones and they add new things in the new ones. So we may have a product from the same company with a similar name, but oh, you bought this in 2005 and you bought this in 2015, and so there's some differences we need to know. Um, and so we do that whether it's a product that we sold or if we have someone come to us, we really make sure that we've learned it as well. And sometimes it's okay, maybe you shouldn't have bought this. And sometimes it's, you know what, this is a great option for you. We should keep it. But just want to make sure that whoever you're working with is aware of how it works and that understands all the little nuances in there. So a lot of little references in here. Again, this will all be available online on our client center. If you have any questions, you can reach out to myself or one of the other advisors here. We are all familiar with the different products, and if it's something that you have outside of working with us, happy to take review with it and even do conference call with you to make sure that everyone understands what you're working on. With that, I'm just going to check again if I have any additional questions coming in here, and it looks like so I don't see any additional questions coming in here. If anyone does have any, please feel free to reach out after if you would like, or I'll stay on here for another moment or so. But uh, just the big thing to be aware of, annuities are not appropriate for everyone, but they're appropriate for some people. And so we want to just, if you have one, make sure you understand how it works. If you're interested, if it's something where, you've thought of it, but just so your neighbor told you shouldn't, maybe you should continue to have that conversation. And they can be appropriate for certain people, but there's just a lot of nuance in these. So that's why, on a high level, wanted to touch on them. Happy to review any existing or new options for people in the future. Thank you, everyone, for joining, and I hope that you have a great rest of your day. Thank you.